Well, the Bank of Canada, they just changed the game. And if you have a mortgage in Canada, maybe you're thinking about buying a home, or maybe you're just renting right now, but you feel completely priced out of the market, the decision is going to impact you way more than you might think. In the video, we are going to break down 3 different things: what the Bank of Canada actually did, what it means for fixed and variable rate mortgages, and the renewals that are coming up, and 4 questions that you have to answer before you absolutely get into a new mortgage. So whether you are a first-time home buyer, an investor, or just trying to survive your renewal coming up here, stay with me till the end of the video. I'm going to give you a simple framework here that you can literally screenshot or take some notes and call your bank or broker and ask these very important questions. The first thing we want to address is, so what actually happened? What did the Bank of Canada actually do? Well, they changed their tone big time. The Bank of Canada made a move that changes the direction of the entire housing conversation. The Bank of Canada has shifted their tone from whatever it takes, we must crush inflation, to a we need to just balance out inflation and people being actually able to live. For the last few years, Canadians have been on a roller coaster with rates and prices, and we went from those emergency rates to some of the highest rates in recent history, to this moment where the bank is finally signaling, okay, things are changing right now. And I'm not going to drown you with all the economical jargon here, but what matters to you is that your borrowing costs are no longer in full sprint upwards, and that is great for you as a homeowner or a potential homeowner. The conversation is now shifting. It's going to the how long will these rates actually stay steady here, or will it ever actually come back down? Now, the real question is, what does this actually mean for your mortgage? Now, let's address some of the questions that I am constantly approached with, and that is, well, do you go with a fixed or do you go with a variable rate mortgage? And obviously, I do not know. I do not know your full situation through the screen here, but how this Bank of Canada decision affects logic behind that choice. Of course, I do not know your full situation behind the screen here, but here's how the Bank of Canada decision and way they're speaking actually can affect your choice here. Fixed rates, they are the security play. They are simple. You know exactly what your payments are going to be for the foreseeable future. You've potentially locked in for 3 or 5 years, and you can be safe to say that that will be your payment for the foreseeable future. You can budget around it. It isn't going to give you a lot less stress. And for a lot of people who just have lived through the variable rate roller coaster, like myself, you might want some predictability after the last 5 years, and it might feel like a warm blanket at nighttime. And the Bank of Canada's move here is changing the game, because if the market believes we are near or at the peak of these rates and rates start to become attractive again, you might be tempted with that variable. You don't want to lock in a high rate for too long and actually see lower rates and think to yourself that you could have actually saved some money. So instead of asking fixed or variable, which is better, because there's really no true answer, you don't know what the future holds, the smarter question is, what term makes sense for me right now in my current situation? For some people, that might be a shorter fixed term. That may be something for 3 years fixed, ride out some of the turbulence, and then adjust on the fly. And for others, they just want that 5-year fixed, and they can value their sleep and know that even if the rates go down a little bit more, they are happy knowing that their payments aren't going to change for the worse. Now, the variable rate play, it is the opposite, of course. It is risky. It is something that you could be riding another tidal wave or roller coaster, and I think rates personally might come down a little bit more. It could save you some more money over the long term. And this is where you have to decide whether you believe that that's the case, or you maybe think, I don't want the slightest percentage that that's going to backfire on me once again. So let's be real here. If you took variable in 2021 or 2020 and you watched your payment skyrocket, I know mine went up about $1,200 a month. So you probably got some PTSD along with me here, and you should make this decision based on if you can stomach that again. It may not be the same, but there's always that slight chance that things can go bad, and only consider variable if you are comfortable in knowing that it could go that direction. And if you do choose going with variable, you got to be smart. You got to use any savings that you actually get by choosing the variable rate lower mortgage to actually pay down your mortgage further with lump sum payments and take advantage of the lower payment. That's really the way to capitalize. Now, on the renewal side of things, this is that silent crisis where the decision is really starting to hit home for a lot of people. In Canada, most people renew every 3 to 5 years. What does that mean? It means a huge chunk of mortgages are coming up very soon. And we know a lot of people in that pandemic time had a much lower mortgage, and now they are going to be at a much higher rate on their renewals. So be very careful with the rate choice that you make. And right now, it might be a relief to some of us that we are hearing the Bank of Canada is not freaking out anymore. They're not panic lowering the rates, but we need to understand maybe we're going to be living with these current rates for a lot longer than we might think. Obviously, rates are not going to go back down to 1 or 2%. There's no way that they would make that mistake again in Canada, but maybe we're watching this video in a few years and saying that guy really said the incorrect thing. You never know how things are going to play out. Now let's talk about something that does not get enough attention. That's how lenders actually start to look at your income, especially rental income and investment properties. Because as the rates started to go up, a lot of people got squeezed out, not just by their payment, but by the qualification rules. Now the lenders, they're going to look at rental income a lot different and treat that income differently than they would just the money that you're making as a salary. They're going to use a percentage of, say, rent, about 50 to 80%, and offset it against the expenses. Now, others will add rental income to your gross income and still use the conservative numbers here. Either way, the Bank of Canada's move affects all of us because the higher or lower rates change your debt service ratios here. This can be the difference between approved and declined, even if nothing in your life has changed. So if you have a basement apartment, a duplex, a condo that you are renting out currently, the rules around how much that rent the lender is going to recognize can completely change what you're going to qualify for on the mortgage side of things, especially heading into 2026 and beyond as the guidelines are ever evolving. Now, for those who are investors, or maybe you want to become an investor, this environment is extremely different. It's not 2016, 17, or 2021. Lenders are now asking, is this property truly cash flow positive at today's rates with the current rental amount you're going to be getting from that tenant? Can the borrower actually handle this property if it is vacant for a long period of time? What happens at renewal if the rates haven't dropped as much as everyone hopes? The Bank of Canada changing the game does not mean that, yay, investors can go nuts again. It means that the rules of the game are more clear right now. You're going to have to play things smart, but you likely are not going to have the extreme volatility that we've had over the last 5 years. Does this deal still work at today's rates and at renewal if nothing improves? Those are some qualifying guidelines you want to keep in mind here. Now, of course, as promised, I wanted to give you 4 questions to bring your bank or your mortgage broker as you are approaching your renewal or going to get your mortgage. And these 4 questions are questions that we tell our clients that they should be asking as you are having this conversation. So how much payment risk can I actually handle? That's very important. Not what the spreadsheet says, not what your most optimistic self says. What can you actually handle without losing sleep? Living off credit cards or praying every rate announcement that it doesn't destroy your ultimate budget. If a small change in payment completely wrecks your month, you probably need to go with a fixed rate or you need a smaller mortgage. The second question you should be asking is, what is my realistic time horizon? Are you likely to move in 2 to 3 years? Upgrade because you're going to have kids. Downsize. Your time horizon should affect whether you choose a 3 or a 5-year term, and it's really going to make a big difference if you go with a fixed rate or a variable, because your penalty to break a fixed rate mortgage is going to be much higher than if you're breaking a variable rate mortgage. And a lot of people lock into 5-year products and then they pay a massive penalty because life changed a lot faster than they expected. The third question to bring to your mortgage rep is, what if rate plans don't move the way I hope? Everyone loves the story where rates are going to come down soon and everything will be fine, but what if that is not the case? Or what if they do come down, but it's just slowly? Ask yourself, can I live with this rate for the next 3 or 5 years? That's really what it comes down to on the variable side of things. Do I have room in my budget to overpay for a mortgage just a little bit? Do I have some backup options out there, a HELOC, savings, the ability to cut other expenses potentially? And if the honest answer is no, you need to look at your numbers more conservatively and maybe choose a different type of house with a smaller mortgage requirement. And the final question you want to bring to your bank or broker is, what is this mortgage helping me do? A mortgage is not just how do I get the lowest rate. It's what is this helping me actually accomplish in my life? Are you buying your first family home? Are you trading up for more space? And are you trying to get out of renting potentially? Building a smarter portfolio if you are looking for long-term wealth. The right mortgage for I just need a stable family home for the next 10 years is not the same mortgage that you need if you are looking to flip something in the next 2 to 3 years. And once you're clear on what type of mortgage it is that you actually need, your decision on choosing fixed versus variable are going to be a lot clearer for you. Now let's zoom out. The Bank of Canada just changed the game by changing the direction of the tone of that rate conversation. But the game itself, mortgages, renewals, qualifying, affordability in Canada, it's an extremely tough game right now in itself. Here's what I would recommend. No matter where you are in this process, no matter what the Bank of Canada says, if you are 12 to 24 months away from your renewal, do not wait for a surprise letter from your lender. Call them ahead of time. Look into what that looks like for you in the future. I've talked to my lender. You can watch that video here and learn about what that process looks like on the renewal side of things. And if you're thinking of buying right now, stop guessing what you can afford. It doesn't help you. You're going to window shop, get pre-approved properly, stress test your budget at today's rates, and you will quickly have a decision that works with your lifestyle. Maybe it's not buying a house, maybe it's renting, or maybe buying a house makes a ton of sense for you. And if you're an investor, underwrite your deals using a realistic vacancy rate, because it is possible your property might be vacant for a lot longer than you might think, and you might be getting a lot less for rent these days than you might anticipate as well. Make sure that the property even works if cash flow is thin for a while. Focus on strong fundamentals, location, tenant demand, long-term growth of the property. And if you're looking at all or thinking of getting into the market, you have no idea where to start, feel free to reach out by scanning the code on the bottom here, and I can help you connect with a local mortgage broker, or I can help you navigate the challenging real estate market. Thanks for watching this one, and I'd love to know in the comment section down below if you're renewing today or if you are getting a mortgage today. Where are we going? Are we going fixed? Are we going variable? What makes sense for your specific situation?